If you're interested in learning how the CRT methodology, or candle range theory, works, this is your video. In this video, we're going to look at how CRT works in a simple and straightforward way, and how to apply it day by day to generate profitability. Let's get into it. First of all, we're going to start with the very basics, what CRT means and how we can identify it. Basically, what CRT is telling us is that candles are ranges, and that price moves from the high to the low of that range. This aligns with what I've mentioned in previous videos, that, in my view, the market is constantly moving from highs to lows. That's exactly what CRT teaches us in an objective way. So, let's take a look at it. I've taken this first example. Here we have a candle. This is a possible range, and we're going to see what needs to happen for this to be considered a valid range. We will mark the high of the candle and the low of the candle. In this case, it is a daily candle, therefore a very important candle. You can see that it is an expansive candle, so this already has a high probability of becoming an interesting candle. Let's see what the next candle does. In this case, the next candle takes the high and closes back inside. When this happens, it turns into a range. Now this is a range. We have taken the high, and the next objective is the low. If this candle were to take the high and not react, meaning it does not close back inside, imagine a strong close outside. What that would tell us is that the trend is likely to continue bullish, and that the next objectives would remain the highs of the previous candles. In our case, since it takes the high, reacts, and closes back inside, what we are going to mark is this is the objective. This is on the daily time frame, and it can be used on all time frames. But to keep things simple, we're going to see how it would be used on daily, 4-hour, 1-hour, and 15-minute timeframes for entries. What we are going to wait for now, once the manipulation has already occurred, is for the next candle to be an expansion that completes the range. And this is basically what the CRT candle pattern consists of. Now we're going to go a bit deeper. Normally, this candle is just going to be a manipulation candle, and the next candle is going to be the expansion that completes the objective. Therefore, the one we are going to want to trade is this one. Now, this is on the daily time frame, and for example, this is a day where this move was around 120 pips. Because of that, it's unlikely that this candle would have both the manipulation and the expansion within the same candle. But you need to keep in mind that on the 4-hour time frame, and we're going to see some examples, many times the turtle soup will happen, the reaction will happen, and the same candle will be the one that already completes the range. Because of that, this should not be used as a strict pattern, but rather as a context. Like I've already told you, for me the market moves from highs to lows, and what CRT does is objectively mark those highs and lows. Everyone can see that this candle has a high and a low, so there's no room for discussion. And that's what I like about CRT. Just by looking at the daily time frame, the trade we could take in this case would be on this candle, using the power of 3 of the candle, with the target at the low and the stop loss above the manipulation. That would be the trade that CRT would give us here. Since this is the daily time frame, price actually gives us several opportunities to take a trade. Many times, if you've watched other explanations of CRT, almost everyone will tell you that the third candle is always where you should take your entry. But that's not always the case, because in reality, the optimal entry was here during this candle. Therefore, I differ a bit from the rest of the people who always want to use the third candle, because the optimal entry actually occurs during the second one. So in this example, we're now going to drop down to the 4-hour time frame to see how the entry could have been taken here. We have the daily range marked. We're going to leave it on the chart. And now what we're going to do is basically look for the same thing on H4. What we have here on H4 is another range, which already points us in the direction of the daily objective. What happened here? This was the manipulation that occurred during FOMC, which is something that shouldn't have happened, because once the range is already created, we should already be moving in the intended direction. What happened here is that both the pound and the dollar, let's look at the dollar now, the dollar had a monthly objective. We're going to mark it here now. As you can see, the dollar had this monthly objective perfectly marked by CRT, as you can see here, and it was taken precisely during FOMC. Okay? That's this wick right here, and it's this wick on the euro. So this is just to explain the context of why the first H4 range is not respected and why we get another turtle soup. It's because, in the case of DXY, we still had a higher time frame objective left to complete. Let's continue looking at the euro on H4. We've already explained why this second turtle soup happens, but otherwise, what we would have here is this H4 range to continue moving in the direction of our daily bearish range. So this one up here would have been the ideal entry. The problem is that because of this, it probably would have ended up as a break-even trade. So now, let's focus on the entry we could have taken on the second day, which would already be on this candle here, okay? On Thursday the 18th, using the power of 3 of this candle to move toward the objective. Just looking at the power of 3 of the candle is not enough, because we would be entering blindly into a wick. What we want to do here is look for a logical entry point, not just see a wick and say, where is this going to stop? That's where we drop down to H4, and what we're going to do is look for a favorable range. What we have here is that at this moment, price takes the high of the previous candle and closes back inside, forming a range and giving us the opportunity to take the trade toward the daily objective. And here, it's more of the same. If we wait for the third candle, we are already very far from the objective. This is where, by not waiting for this candle to close and confirm the range, we can go down to H1 and already look for a range there. As we had here, in this case we have the range right here, and it's very clear that the trade could have been taken earlier, up here, waiting for the turtle soup of the H4 candle, which would be this one here, to close and form the range, then wait for a bit of reaction. Now we would move down to M15, with the objective to the downside. And this trade was perfect using CRT. We had our target using the daily CRT, and our entry using the H4 candle that is right here to move toward our objective. We used H1, so we didn't have to wait for the H4 candle to close. And if we go down to M15 to look for an order block for the entry, what we get is, look at this, an almost perfect entry. When this candle closes below this one and forms the order block, we can enter our trade right here. This gave us the stop above. The turtle soup could have even given a 5R. I never go that far. When we have several ranges like this, H1, H4, and daily, what you can do is take profits as objectives are being completed. We take a partial here, another partial here, and the final TP down here. This is the perfect explanation of how CRT would be used for trading. Now let's go with another example, and this one is really going to blow your mind. As you can see, we're coming from taking a very important low, and what forms here is an H4 range. You can see it very clearly, right? How this candle takes the low and then closes back inside, forming this as a range. Now, how can this day be traded? Simply by looking at H4, H1, and M15, it can be traded perfectly. We have the objective up here. It's important not to trade this strictly as a pattern. This does not mean that every range must always be fully completed. In this case, we're coming from taking a very important low, and we're coming from a strong bearish expansion, so a retracement makes sense. Because of that, it was very likely that this range would be completed. So, how can we trade it? The turtle soup happened during an hour when I was no longer on the chart. So the 2 candles I was actually watching were these 2. So, how can we trade this? As you already know from my channel, we always have to look for a turtle soup in our favor. On H4, which is the only turtle soup in favor that you see here. I'll give you a second to spot it. Correct. Hopefully you got it. It's this one right here. This is the only turtle soup we have that is in favor of our objective, which is up here. So the only moment when we could take our buy, just by looking at H4, was right here. Now let's look at H1 and M15 to see how this trade could have been taken. Let's go to H1. What did we have here on H1? How did this bearish range transform? Is this range interesting to us? No, because our objective is bullish. So all this tells us is that we still shouldn't be buying yet. We need to wait until everything is aligned in our favor. When do we start having things in our favor? At the moment when, on H4, we form the bullish turtle soup and then observe the reaction. Now let's go down to M15 to see what happened. And indeed, as you can always see, an order block forms, in this case right here. And that's where we had our entry. We could take the entry around here, with the stop loss below the turtle soup so it's safe, and the target up there. Why is my entry so late? Because here I was waiting for the order block to form. By waiting for the order block, price moved a bit without me, but the stop loss still has to remain very safe below the turtle soup. There are very few times when price will need to make another turtle soup before moving toward the objective. Normally, if the turtle soup is already done, this is a point where price should not need to go lower again. As you can see, this example is simply about using a bit of context, coming from taking an important low, using the H4 timeframe to observe the range, using the H4 timeframe to see when the chart is aligned in our favor, and using M15 to decide when to take the entry. What I love about M15 is that if we're here, the first order block that forms after we already have the range in our favor is this one. If price were to keep dropping without forming any order block, then my idea could be completely wrong, but I wouldn't enter the trade. That means I would be wrong, but without a stop loss. And that's much better than trying to be right and getting stopped out. So this would be the perfect entry using CRT. You can see that it's mechanical, objective, and that we're all looking at the same thing. There's no subjectivity here, just the ability to slightly anticipate a trend change at this point after taking an important low. For example, on H4, the 1 o'clock candle corresponds to the London session, the 5 o'clock candle to the London close, and the 9 o'clock candle to the New York session. These are important moments, the opening of H4 candles, because they are times when turtle soups are more likely to form, either in favor or against. So these are hours you need to pay close attention to, and you should know that they are New York time. So that's it. I hope you liked it and that I was able to bring a bit more clarity to the topic of CRT. I know there's a lot of information out there that can be a bit confusing, and I hope I was able to help. If you like this video, if you like the topic of CRT, let me know in the comments, and I'll try to also do weekly summaries of my trades like I did here, explaining why I took them and the reasoning behind them using CRT.